Beware of Greeks bearing bonds was the title of a Vanity Fair article in 2010 by Michael Lewis, which explained that Greece was on a slippery slope. Markets reading on the news that Greece will default, and it did default on Tuesday night, became the first advanced economy to miss a payment to the IMF, joining the likes of Cuba and Zimbabwe and Sudan in going to the lender of last resort with empty pockets and saying, terribly sorry, we can't pay you money that we've borrowed. Is it doing anything to your investment portfolio? This is Tonight. I'm Bruce Whitfield. Tonight I'm joined by Roland Rousseau, who's the head of Barclays Risk Strategy Group, to discuss how risk is managed. I mean, there was a time where asset managers, fund managers would go off and buy Greek bonds because they paid wonderful yields, and a lot of people made a lot of money out of Greek bonds for a long time, didn't they?
One has to differentiate the return from risk, because when you're going to chase high-yielding instruments, you're getting a higher return, but it comes with generally some kind of higher risk. And the task of good risk management is to understand, is that risk compensated, is the return compensating you for that risk?
So if you go on March 2010 to March 2015, ka-ching.
Exactly. So there's often confusion when we try and understand whether a fund manager is actually adding value, because the definition of skill is not whether you've got a higher return, it's whether you've outperformed the risks you've taken. That's at least how it's technically defined. So you've got to stock pick or market time your investments to get over and above that, the risks that are inherent in the strategy.
Ordinary schmucks like myself, okay, who don't really understand the risks and who simply want to see the returns, and we want to see consistent returns, and we want to see those returns outperform alternative investments we might have made. That's the way us in the real world look at it. Do we not make it a bit too complicated?
Well, we do make it complicated for a specific reason, because you want to actually know who's really good at managing wealth. So if we take the Greece situation or we take the South African situation, you have a lot of people outperforming cash, which they do with credit, which is sort of the problem we're having in Greece right now. Mm-hmm. So it's easy to outperform cash by taking that risk. It's just, can you get out of it, or can you time it? And that's where the skill comes in, and not many people can justify it.
Up until 2008, bonds were seen as risk-free. Largely, regarded, they're not risk-free, but regarded as risk-free. Suddenly, bonds nearly killed Old Mutual. That unwind some very serious positions in the United States in the bond market there. Suddenly, we saw African Bank with huge amounts of debts raised on capital markets. Suddenly, risk became real. And for the Greeks, who owe 3.2 trillion euros, 3.2 trillion euros or thereabouts, they've taken an awful lot of risk.
It's called leverage. It's something that's all too familiar.
It's what killed Lehman Brothers.
It's what kills a lot of people, yes.
So why don't we learn from these lessons? Because if it killed Lehman Brothers and it killed African Bank, I mean, different examples, and it's killing Greece.
Well, I guess the obvious answer is we don't focus on the risk, we focus on the return. So we don't see the risk building up behind us. But coming back to your point, saying bonds are or have been sort of risk-free, what's worrying us at the moment really is that equities are giving us a bit of a free lunch, in the sense that they have done exceptionally well at very low volatility. They have the lowest volatility relative to bonds than they've ever had before in South Africa.
What does that mean?
So that means that you are getting equity-like returns for bond-like risk, and that's not sustainable. So we expect that to unwind, which means that equity volatility should be rising from here, just to get back to where its average is relative to bond risk.
And volatility is exciting. Volatility is good. It gives us stuff to talk about. But when it comes down to risk, and for me, going to make an investment, I go back on track record. I listen to interviews, do interviews with people, and I go, smart individual, decent track record, let's pop some money into fund X, Y, or Z. I don't assess the risk. I'm incapable of assessing the risk. Or am I?
Well,
or is there something I could do to help understand the risk?
Absolutely,
what I'm
doing? You can. What you should do is you should always look at what the manager's investing in, and look at what the benchmark is. And if there's a mismatch...
But how do I do that?
Well, for example, if somebody is a value investor and they have the all-share index as their benchmark, they are taking value risk. Value investing is not safe, it's risky. That's why it's worth taking it in the long run, because you get compensated for that risk. But you can be wrong, as most value managers have been in the last 5 years, because we've been in a momentum market, because there's lots of easy money and the markets keep going up and up. So everything is risky, but you've got to match the fund manager and the benchmark to the same risk. So if a fund manager has a cash benchmark and is investing in Able, you should know that that's credit risk, not skill.
Okay, so they're outperforming as a result of gambling, effectively.
Well, taking hopefully risks that are prudent.
Calculated risk, gambling.
Calculated risk, yes.
Isn't that the same thing?
It is. It has similar payoffs, but it's not necessarily the same thing. Yes.
But okay, so when it comes to making investments and sensible investment decisions, we've got to try and assess the risk of what we're investing in. We look around the world today. We look at what's happening in Greece, and this is a moving target. Fair enough. The Greeks look like they're trying to do a deal. The deal, however, goes to a referendum on Sunday. It'll be delayed and postponed because nobody wants to write off the debt. The IMF still wants to collect at least 10 cents in every euro, whatever it can get for its debt. This doesn't end soon, does it?
No. We actually monitor many different risk indicators, and one of the key indicators that we look at is what we call dispersion, or how integrated markets are. So if markets are not very integrated, they're diversified because something's going up and something's going down, and they're sort of meandering randomly through time. Whereas when things are very highly integrated, you have a lot of potential risk. So if something happens, you're going to have a big unwind in all asset classes, which is what we saw in 2008. We don't see that actually happening right now.
I was chatting to a guy at Investing Asset Management yesterday in London who was saying that 3 years ago, this would have been a very different story. Absolutely. If the default had happened 3 years ago, we would have seen some very serious global consequences because Greece was far more integrated. Greece now
Correct.
is far more removed.
It's actually a small issue, but it's becoming a big psychological issue, but the fundamentals aren't being affected by it.
Okay, now, far bigger risks in the global economy right now is American interest rates. Correct. As bizarre as that might seem for us sitting, 18 hours away on a decent flight from New York.
There's one degree of separation. So if the interest rates are going up in the US, it's not the interest rates that affect us, it's actually the dollar. So the dollar right now is we've got three key variables that we're watching at the moment. The US dollar, obviously. Emerging markets' performance is also heavily impacted by the oil price, and the third metric is the sort of risk appetite kind of attitude at the moment in the market. So with a stronger dollar, we are going to get hit, and that's where the interest rates come in.
And absolutely, we got that particular problem. Plus, our biggest market for commodities, China, is sort of backpedaling and doing its own thing and going, hold on a second, we don't know how fast we're growing, but we don't like it because it's not fast enough.
Which is also bad for emerging markets. So we're quite negative on our equity market from a risk perspective.
Okay, then tell me what to do. There's 10,000 Rand sitting in the family account and you want to apply it somewhere. South Africans, if anything, are quite used to risk. We wake up in the morning, for goodness sake, that's quite a risky activity in some parts of South Africa. We get into our cars, that's a risky activity. We go through the office car park, which can be risky depending on who's hanging around. And we go and deal with our boss, which is infinitely risky as well.
You get stuck in a lift and there's an Eskom power failure.
And you get stuck in a risk. So we're used to taking risks, but when it comes to our money, we treat that risk very differently. How are we going to treat investment risk right now as South Africans in a wobbly global environment with a rubbish currency backing us?
Yeah, look, our economists are still bearish on the currency, so we still certainly suggest people should keep an offshore allocation. But equity, we have three types of bear markets. We have what we call a teddy bear market, a polar bear market, and a grizzly bear market.
I love the way you've made this technical. Okay, so take me through them quickly.
So a teddy bear is obviously a short-term kind of bear market, and then a polar bear market is a sustained but gradual bear market, and then a grizzly bear is basically a crash.
Massively aggressive, yeah.
So we actually think we are in a sort of polar bear kind of situation where we're going to have steady unwinding of the equity risk premium. So it's basically a risk-off environment that will stay. And it's an emerging market story. It's certainly not a global story. The US is very different to South Africa. So we have to condition it on that. And obviously there are domestic factors that also are not looking that rosy in South Africa. So we're advising our clients to de-risk away from equities. Unfortunately, bonds are also quite risky at the moment. But
then where does the money go? You don't put it in cash. Surely you can't be recommending that.
The best thing is to wait till this Greece story is sorted out. So we actually are saying to people, de-risk to the end of the year and then reassess. Because
what does de-risk mean?
De-risk means lower your most risky assets, which is equities.
And then what do you do with that cash?
Exactly, it's mainly offshore and cash, and we think.
And how long do you sit on that cash? Because so many people. I mean, if you look at the tumultuous times of 2008, the market went from 34 to 17,000. It halved in value in months, and then people sat on cash to 21,000. Oh no, it's not a. What kind of bear would that be? That would be.
I'd rather have my money in cash in South Africa than offshore at this point, and also. an underrated asset class at the moment that most retail people probably don't look at is inflation-linked bonds, because they actually, with the risk of inflation coming through in our market, actually can provide you with a lower risk. Are
you forecasting a 10% pullback in markets? I mean, if we're looking at the all-share index on the JSE 52,000, we can pull back to 48?
We preempted this too early. In other words, the market did do quite well and then came off since March, I think it was. So we've been in that kind of secular teddy bear market and now going into the polar bear kind of cycle. So yeah, another 10% is nothing unusual for the market, and it's probably quite healthy.
No, I mean, I would like an opportunity to buy something on the market. Exactly, it's a scary place. What makes the polar bear go grizzly?
Well, I guess some kind of Greek unwind and an increase in this integration of asset markets or asset classes around the world, which we're not seeing. So we have a very low probability of the grizzly coming out.
There we go. It's the three little bears this evening on Tonight with Bruce Whitfield. Roland Rousseau is head of Barclays Risk Strategy Group. Thank you for watching. There'll be more stories tomorrow night. We'll see if we can get Goldilocks to come and join us next time as well. Not too cold, not too hot, not too cold. Good night, goodbye, and thanks for watching.